Do you have highly appreciated company stock inside your 401k? If you do, are you planning to roll over your 401k to an IRA anytime soon? Whether you're retiring, changing jobs, or just taking money out of your 401k while you're still working, you might be about to make a costly decision, a mistake that could instantly wipe out hundreds of thousands in tax savings. You've done everything right. You've maxed out your contributions, managed your investments. But for executives with highly appreciated company stock in their 401k, there's a critical evaluation you need to make. Will you pay the highest ordinary income tax rate on your gains? Or will you secure the much lower long-term capital gains tax rate? Missing this evaluation, that's 401k critical mistake number 3, and it's completely preventable. Hi, I'm David Dunn, a CPA, wealth, and tax strategist with David Dunn Wealth. I'm the creator of the Critical Mistakes series, my signature educational platform designed to help executives avoid critical mistakes, some costly, others irreversible. For over 30 years, I've helped technology and aerospace executives navigate the complexities of their wealth, from optimizing their 401k and RSUs to managing executive compensation and tax strategy. 401k critical mistake number 3, it's simple. Rolling over your 401k to an IRA without first evaluating if your company stock qualifies for special tax treatment. This mistake happens because many executives assume, quite reasonably, that rolling everything in their 401k to an IRA is the smart move. But when company stock is involved, that assumption could cost you hundreds of thousands in avoidable taxes. Let's look at what this mistake could cost you. Meet Sarah, age 60, an executive approaching retirement. Her 401k is worth $1 million, which includes highly appreciated company stock. Sarah's tax situation: 37% ordinary income tax rate, 20% long-term capital gains tax rate. Sarah rolls her 401k to her IRA as advisors often recommend. Later, when she withdraws that $1 million, she'll pay ordinary income tax on the entire amount. At 37%, that's $370,000 in taxes. But what if there was another option? There's a little known provision in the tax code called Net Unrealized Appreciation, or NUA. Here's how it works. Say Sarah originally contributed $100,000 to purchase company stock in her 401k. That initial $100,000 is her cost basis. Over the years, that stock grew to $1 million, creating $900,000 in gains. The NUA strategy could potentially allow Sarah to pay ordinary income tax on just her $100,000 cost basis and long-term capital gains tax on the $900,000 in gains when she chooses to sell. Let's break down the tax. On the cost basis, $100,000 at 37%, that's $37,000. On the $900,000 of gains at 20%, that's $180,000. The total tax using net unrealized appreciation, $217,000. Compare that to the $370,000 she'd pay with rolling over the company's stock to her IRA. The potential difference, $153,000. Additional federal and state taxes may apply depending on your situation. The net unrealized appreciation strategy requires specific steps and precise timing. Step number 1, confirm you're eligible. You'll need a triggering event. Step 2, transfer everything in your 401k that's not company stock to a new IRA through a direct rollover. Step 3, transfer the company stock in your 401k in certificate form to a taxable brokerage account. Step 4, ensure these transactions qualify as a lump sum distribution. Step 5, complete everything so your 401k balance is zero by December 31st of the same year. The NUA strategy is filled with complexity and easy to kill. Once you roll that specific block of company stock from your 401k to your IRA, you cannot reverse the decision. For those shares, the NUA opportunity is permanently lost. So, before you finalize that 401k rollover, here is the crucial advice. First, determine if you hold appreciated company stock in your 401k that might qualify for NUA treatment. Second, consult with a qualified advisor. They need to understand the NUA rules inside and out to help you evaluate if this strategy is right for your unique situation. And third, if the NUA strategy appears beneficial, consider implementing it correctly before taking any other action with your 401k. One wrong action, like selling company stock or taking distributions, could immediately disqualify you. There are 3 other critical mistakes that can destroy your NUA opportunity. Make sure you watch 401k critical mistake number 4, 401k critical mistake number 5, and 401k critical mistake number 6. You've worked hard to build wealth through your company stock and your 401k. Don't let a well-intentioned IRA rollover decision cost you tens or hundreds of thousands in unnecessary taxes. The net unrealized appreciation strategy isn't right for everyone, but if you qualify, it's one of the most powerful tax moves an executive can make. This is 401k critical mistake number 3, the first of 4 videos covering the most costly mistakes executives make with their 401k company stock. Be sure to watch 401k critical mistakes 4, 5, and 6 to see some other ways you can lose the NUA opportunity. Want to stay ahead of these issues? Here's what to do. Subscribe to my complimentary email newsletter. You'll get insights from the Critical Mistakes series delivered straight into your inbox. Follow me on LinkedIn, YouTube, and Instagram for ongoing updates. And if you'd like to explore working together, schedule a complimentary 30-minute consultation at daviddunn.com. If this video helped clarify a complex issue, please like it, subscribe, and share it with colleagues who might benefit. Thanks for watching.